First off, I want to wish everyone a happy new year. January is the time when financial rules reset. New tax brackets, new contribution limits, and updated thresholds. Most people see this and think, great, it's paperwork season until April. But for those who plan intentionally, this is actually one of the most powerful moments of the year. These changes create opportunities to make strategic moves, optimize your accounts, and set yourself up for the year ahead. So today, I want to focus on 5 things to think about as we start the new year. 5 areas that can have a real impact on your finances if you approach them intentionally. The first thing to think about is contributions. We want to make sure that you've contributed everything you're allowed to for 2025. That includes Roth, traditional IRAs, and HSAs. It's easy to overlook leftover contribution opportunities, and even small amounts can add up over time, especially when you consider the tax advantages in compound growth. The goal here is pretty simple. Make sure every dollar you're allowed to put towards your future actually goes in. For some clients, that's catching up on 2025 Roth contributions, and for others, it might mean topping off an HSA. Think of this step as claiming the benefits that are already available to you. You don't have to make complicated decisions yet, just make sure you're not leaving money on the table. Additionally, if you are making periodic contributions to a Roth IRA or 401k, make sure that you're taking advantage of these increased limits for 2026. The second point is sequencing your accounts with intention. It's not enough just to fill your accounts, the pre-tax, Roth, after-tax, HSAs. The order really does matter. Your income changes. Maybe it's a bonus, a stock award, a side hustle, and that can shift what's smart this year versus what worked in the past. Think of it like planting seeds. You want them in the right soil to grow depending on what your goals are. Put them in the wrong place and you might miss out on growth or tax benefits. If you put them in the right spot, you're setting up yourself for years of advantage. Number 3 is watch out for phaseouts. When your income increases from last year, you might quietly be unable to make Roth contributions, IRA deductibility, and child or education credits and deductions might vanish. For example, if you were making Roth contributions throughout the year, but receive a large either bonus or equity payout later in Q3 or Q4 that pushes your income higher than you were expecting, you could face penalties on those excess contributions. Trying to plan early means you can steer, adjust, and avoid losing potential benefits you didn't even know you were at risk of losing. Without it, you're driving with a fogged up windshield, but with it, you can see clearly, make smart moves, and keep more of your money working for you. The fourth thing is planning for deductions and credits. A good rule of thumb for me to remember which one is which is that deductions are about managing your tax rate, basically lowering your income where you can. Credits are about incentivizing specific behavior, like having a child, education, and even energy efficiency. Instead of asking, how do I get the biggest write-off? We should be asking from a planning lens, what behaviors do I want to encourage? Should I shift income to make a credit usable? And is this deduction more valuable now, or would it be more valuable later? Even charitable giving is strategic. Pick causes you care about, plan out the timing, and make it meaningful. For 2026, those people that are married filing jointly, even if they take the larger standard deduction, are allowed to use an additional $2,000 for charitable causes. So if there is a cause near and dear to your heart, it might be worth talking to us over here at Cutler to make the best plan forward about how to give generously to those. And finally, the last point I want to touch on is budgeting. Even high income earners need a budget, but not exactly what you would think. We want to make sure that you're able to preserve your flexibility, chase different opportunities, and prevent lifestyle inflation from quietly eating away at your goals. Clarity over your cash flow gives you options. If you want to do a Roth conversion, take advantage of an investment opportunity, or adjust for a life change, you can. Without clarity, you're just reacting. With it, you're in control. Think of it as building a toolkit. The more options you have, the better decisions you can make when opportunities or challenges come your way. If you don't have clarity about where your money is going, it will tend to flow towards convenience versus opportunity. So there you have it. Those are the 5 items I really want you to consider as we enter 2026. Number 1 is making your contributions count. Number 2 is sequencing these contributions with intention. Number 3 is watch out for phase-outs along the way. Number 4, using your deductions and credits wisely. And 5, budgeting for flexibility and control. January isn't just paperwork season, it's your chance to take control, feel confident, and set your money up to work for you all year. Do a little planning now, and 2026 can feel a little less stressful, more intentional, and hopefully even exciting. At Cutler Investment Group, our goal is to help you navigate these changes confidently so your financial plan stays on track and works for you all year long.